Hello friends, welcome to this March edition of Monthly Viewpoints. The last month has seen heightened volatility in the equity markets. For example, globally, the Nasdaq index is down almost 4.5%, while the S&P 500 has still held up. Even in India, we saw that the Nifty had reached its all-time high of about 15,500, but then corrected by almost 5 to 6%, then rose back to the previous levels. And now again, over the past few days, we are seeing a minor correction. The question is, what is leading to this high volatility? So the main reason is a sharp rise in the bond yields in the US. So what has happened is that the US government has declared an additional fiscal stimulus of $1.9 trillion. It is expected to drive faster growth in the US, which can potentially lead to higher than expected inflation. So because of this, the US 10-year yields have risen by almost 100 basis points for the past month and have reached almost 1.6%. Now, whenever bond yields rise, it's negative for the equity markets, and that is what has impacted investor sentiment negatively. However, our view is that this rising yields has been driven by growth and expectations of inflation. Now, if you take a step back, all the data points, such as high frequency indicators, are showing that global growth is indeed coming back and has reached to pre-COVID levels. Now, it's possible that it can give rise to moderate inflation, but that is actually good for equities. In the past, we have seen that whenever growth has been coming back and inflation is moderate, it leads to a gradual rise in yields, which is good for equities. It's only when policymakers start raising rates very quickly, that's when it becomes a negative for equities. And our view is that we are unlikely to see the Fed or any other central bank raising equity rates so fast, because they have announced that their intended policy is to maintain an accommodative rates at least for the next few years. Even if inflation were to rise, it's possible that it's only by the end of next year that the Fed can think of raising rates. So overall, the rise in yields should not be a big concern for the equity markets. The second point we are seeing is that there is some news about increasing COVID cases, but vaccinations also progressing well. So COVID is no longer a risk for markets. Also, we are seeing that in India, the growth recovery is back on track. All the high frequency indicators, whether it's the GST collections, exports, e-way bills, auto sales, and so on, are back to pre-COVID levels. The Q3 GDP number, which was announced recently, came in at a positive 0.4% after negative numbers which we saw in the past 2 quarters. So our view is that we are going to most probably see healthy GDP growth coming back, and hence for FY22, our projection is almost a 12 to 13% growth in the yearly GDP, and in FY23, India should come back to the 6.5 to 7% GDP growth rate. So clearly, growth is no longer a concern. Now the question for equity investors is, how does this translate into earnings growth? The Q3 earnings, which were recently announced, came in very strongly, and the Nifty Q3 earnings growth was almost 22%. Management commentary has been upbeat across sectors, and continued demand improvement and cost rationalization has been highlighted. Because of this, earnings for FY21, 22 and 23 have been upgraded to almost 6 to 9%. And hence, our projection is that in this fiscal year, FY21, earnings are projected to grow by almost 14%, increasing to 33% in FY22 and then 19% in FY23. This strong earnings growth should provide a boost to equity markets. So the question that investors always have is, valuation seems elevated. So what should be the view in that regard? So one point to consider is that yields and interest rates are at all-time lows, and hence that can justify higher valuations. Also, earnings currently are not normalized, so it's better we look at the earnings numbers 1 or 2 years down the line. And if we do that, we see that the Nifty trailing price earnings ratio in FY22 or FY23 comes to around 20 times, which is just in line with the long-term average. The Nifty price to book also comes just in line with the long-term average. So overall, we don't think that the current elevated valuations are a thing of concern, because once the valuations normalize, they should be in line with the long-term averages. The last point to note is that the FII flows have still been very strong. Year to date, India has got almost $6 billion of FII inflows after getting almost $23 billion in the last calendar year. And this is expected to continue going forward. So to summarize our view, we have seen a minor correction in the markets because of increasing yields in the US. However, we do not think that the high yields will sustain for a long time, and hence it should not be a concern as long as the growth and moderate inflation drives yields, which is fine for equities. Overall, we are in the early stages of an economic recovery. Monetary and fiscal policy remain supportive. Earnings rebound has been sharp. Relative valuations are still favorable, and FII flows continue to be strong. So we maintain our overweight stance on equities. Many investors have missed the recent rally, and the ongoing correction can give them a good opportunity to add equities to their portfolio. Four themes which can be of interest are the low ticket consumer discretionary segment, banking and financials, industrials and infra, and the technology and digital sector. We provide a basket of funds for investors to choose from. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.